Hey everybody, Jason Rivera here from valueinvestingjourney.com to continue the case study that I brought up on Steiner Leisure, ticker STNR, about a month ago before I took a break from a little bit of burnout. Alrighty, this case study is being done on a company that's about to be bought out, and I'm doing the case study to see if I made a mistake. About a year and a half ago, early 2014, I looked at Steiner and found them to be overvalued. I liked the business, thought they had some minor competitive advantages, but I found them to be overvalued, so I didn't buy them at that time. And then I lost interest in them, stopped following them for almost 2 years, until last month I saw that they were getting bought out by a private equity firm. So I wanted to go back and do a case study to see if I messed up in my original analysis almost 2 years ago, or if the private equity company who's buying Steiner now is making a mistake in buying them out when they're overvalued. Alright, so here we go. Got all the tabs open like usual on Morningstar. First off, I guess I need to tell you how I did this. I went back and reanalyzed the company from early January 2014 when I first found them, and then I analyzed them now on a preliminary basis using my preliminary analysis checklist, which is sent to all subscribers, Value Investing Journey free subscribers. So I did that, and then I will tell you my determinations at the end, and then we'll continue the case study from here. But what I found is last year, as of January 2nd, 2014, the company was worth approximately $723 million. Its market cap was approximately $723 million. It paid no dividend. Its trailing 12-month operating margin was 7%. Its 5-year average operating margin was 8.2%. The total number of shares decreased from 18 million in 2006 to 15 million at the beginning of 2014, or decreases 17% at that time. All this is great, or pretty good. The operating margin isn't great. The decrease of shares is great. This all can be found in the key ratios tab on Morningstar. And from here, I just used this column right here for the numbers to calculate all the numbers, since this is at the end of fiscal year 2013, which is the beginning of fiscal year 2014. So if you're following along, make sure to reference this year's numbers on this page, and also the income statement, balance sheet, and cash flow pages as well. Anyways, let's get back to the numbers. Book value per share increased $9.58 a share in 2006 to $26.77 at the end of the year. That's fantastic. An increase of 179% in that time period. That's incredible. That's always something I love to see. Increasing the book value of the underlying shares while decreasing the number of share count means that the company is doing great things, internally increasing the internal value of the company, even if the share price doesn't reflect the internal value. Underlying book value of the shares rise over time. That means that the company's share price will rise about in the same number. Maybe not at the same time, but they will rise eventually if the company keeps continuing to do well. Its ROIC, let's go down a little bit here. A trailing 12 month at that point was 10.7%, and its 5-year average before that was 13.3%. Pretty good. I look for anything over 10%, so this fits that criteria. Same thing with ROE. ROA here 13.2%, 5-year average 16.9% before this. Pretty good, but when ROE is higher than ROIC, it means the company has debt. So that's something to look at, and I'll look at that when we get to the financial health page or a tab on this page. For now, let's go to the cash flow page. Good free cash flow to sales margin, anything over 5% means the company is producing a lot of cash. And compared to the amount of sales it has in this case, in this year, or at the beginning of 2014, it was producing, for every $1 in sales it had, it was producing 7.6 cents of free cash. Again, anything over 5 cents for every dollar is considered really good. 5-year average FCF to sales margin was 8.9%. Again, great stuff here. Now we go to the efficiency ratios tab and look at its cash conversion cycle number. What this number tells you is how fast the company turns its inventory and into sales for the company. The lower this number is, the better, and this number can be negative for companies like Walmart, Amazon, and the like. If you see this number rising over time, you need to figure out why, and if you find out it could be because a company isn't selling inventory as fast, which is always a bad sign, because if the company is not selling inventory as fast, that it might have to write down the value of some of this inventory, which would destroy value within the company. So you always want to see this number going lower over time, and since 2009 it's fallen nominally. I've calculated, at that time I calculated its EV to EBIT to be 12.43, its EV to free cash flow at 11.45. I like to see both these numbers below 8, because I found that anything below 8 means the company's it's a good sign the company's undervalued, at least on a relative basis. And I calculated its earnings yield, EV or EBIT to EV earnings yield at 8.1%, and its free cash flow to EV earnings yield at 8.7% at that time. I like to see the earnings yield above 10%, so it's close enough, and the other numbers are close enough that I would have at that time taken another look at the company, which I did. But on intrinsic valuations, I found them to be overvalued, so I passed at the time. What is the company doing now? I did this analysis originally a couple weeks ago and just haven't had enough time to do this video until now. So keep in mind that I'm using, the market cap will be different on between here and between Morningstar and my numbers. When I did the analysis on September 8th, the company had an $818 million market cap. So the company has grown by almost $100 million, at least in terms of market cap, in the last almost 2 years. But I don't know why, because you'll see here, look at their operating margin in the trailing 12-month period. It's fallen dramatically, and it's negative now by a wide margin. And same thing here with the book value. Look at the book value, it's fallen more than half in just 1 year, from 2014. In 2014, it was $29.74 per share. In the trailing 12-month period, it's only $14.32 per share. That's an incredible loss of value, and once we get to the financial, we need to figure out why that happened, because that's shocking, and it has nothing to do with the share count rising. I thought maybe it was because they diluted shareholders and sold more shares, but that's not the case. They actually have continued to decrease their share count in the last year. So that has nothing to do with the drop in the book value per share. And you'll go down here, go back to the profitability tab, you'll see the ROIC and ROE both are negative, and by a wide margin. And the debt, we can also see the debt level has risen in the trailing 12 months because the percentage difference between ROE and ROIC is a lot bigger than it was in the beginning of 2014. So before we go any farther, let's go here and find out what happened. Short-term debt hasn't grown hardly at all, but long-term debt since 2014 has grown by 6 percentage points. Not a huge difference in terms of balance sheet strength, but that's where the difference comes in on the ROE and why it's so much worse than the ROIC in the trailing 12 months. Let's go back to that. Negative 54.3% versus negative 39.1%. The more debt you have, the more ROE is magnified compared to ROIC. And that works positively and negatively. As you can see here, it magnified it in a negative way. It can magnify it as a positive way as well if the company is doing what it should be doing, which apparently in the last year Steiner hasn't. And in the trailing 12 months, its free cash flow to sales margin has actually dropped as well. In terms of book value, ROIC, ROE, free cash flow to sales, a lot worse company this year than it was almost 2 years ago. That'll be, and that just goes to valuation as well. I couldn't calculate its EV to EBIT or EBIT to EV earnings yield because EBIT was actually negative by 161.9 million in the trailing 12-month period, which is a massive difference from its EBIT in almost 2 years ago of 59.6, positive 59.6. So that's a swing of almost more than negative $200 million in less than 2 years. Again, something we'll need to find out why and what happened in the financial reports. But I was able to calculate EV to FCF and FCF to EV because the company did have positive free cash flow. But again, this was lower, 44.6 this year, or in the trailing 12-month period, versus 64.7 at the end of 2013. So what does this mean? Well, the company's worth more on an enterprise value basis, but it's producing less profitability, which means that the company's even more overvalued than it was almost 2 years ago. Again, on a relative basis. So this, in the trailing 12-month period, I calculated its EV to free cash flow at 19.7 versus 2 years ago it was 11.45. That's an increase of 8 points and means the company is even more overvalued on a relative basis than it was before, or almost 2 years ago. And same thing with FCF to EV earnings yield. It's lower at 5.1% in this time period than it was almost 2 years ago at 8.7%. So what happened with the shocking loss of value, and why is the company being bought out for such at least on a relative basis, a massive overvaluation, especially compared to 2 years ago? Well, that's where we will dig into the financial reports and find out in the coming weeks what happened and who made the mistake, or am I missing something in the financials? Does it have a lot of NOLs, deferred tax assets, those kind of things that the private equity firm wants to use? That could be the case, but we will see. So please let me know of any comments or concerns in the comment section below. Thank you, and to get access to the preliminary analysis checklist that I use every time I evaluate a company, go to valueinvestingjourney.com and subscribe to the newsletter for free, or to the mailing list for free. And this checklist I used, not only does it help me evaluate companies, but it helps cut the evaluation time down, which helps me evaluate more companies faster. So if you want this checklist, make sure to subscribe to valueinvestingjourney.com. Thank you.